Hello and welcome to Money Mindset Hub, the podcast dedicated to helping you build a stronger financial future, one insight at a time. I'm your host, Raul Sofa. Ever feel like the economy is this giant, complex machine and you're just a tiny cog, wondering how its gears grinding will affect your hard-earned cash? You hear terms like inflation, recession, interest rates on the news, and maybe you've asked yourself, okay, but what does that actually mean for my savings account, for my dreams of a down payment, a comfortable retirement, or even just a stress-free month? If that sounds familiar, you're in exactly the right place. Today, we're demystifying the connection between the broader economy and something incredibly personal, your savings. It's not just about numbers on a screen, it's about your financial well-being, your future security, and your ability to achieve your goals. In the next 20 minutes, we'll explore how economic shifts can ripple through your finances and, most importantly, what proactive steps you can take to navigate these changes and protect, even grow, your savings. So grab a coffee, settle in, and let's get financially savvy. Before we dive into the direct impact on your savings, let's quickly break down a few key economic terms you'll often hear. Don't worry, we'll keep it simple and jargon-free. First up, inflation. Imagine your favorite coffee cost $3 last year. This year, it's $3.30 for the exact same cup. That's inflation in action. It's the rate at which the general level of prices for goods and services is rising, and consequently, the purchasing power of your money is falling. A little inflation is normal, even healthy for an economy, but high inflation can significantly erode the value of your savings over time. What your $100 could buy you last year, it might only buy you $95 worth of goods this year if inflation is at 5%. Next, interest rates. When you save money in a bank, they pay you interest. Conversely, when you borrow money, you pay interest. Central banks, like the Federal Reserve in the US or the Bank of Canada here, often adjust a key interest rate, the policy rate or federal funds rate. When they raise this rate, borrowing becomes more expensive, which can cool down an overheating economy and fight inflation. When they lower it, borrowing becomes cheaper, encouraging spending and investment. For savers, higher interest rates generally mean a better return on your deposits in savings accounts, or GICs, guaranteed investment certificates. Then there's gross domestic product, or GDP. Think of GDP as the total value of everything a country produces and sells, all the goods and services. If GDP is growing, the economy is expanding, which usually means more jobs and higher incomes. If GDP is shrinking for 2 consecutive quarters, that's often defined as a recession. During a recession, businesses might struggle, leading to job losses and reduced consumer spending. This obviously has a direct link to your ability to save. And finally, let's touch on the job market. This refers to the supply and demand for labor. Indicators like the unemployment rate, the percentage of the workforce that is jobless and looking for work, and wage growth tell us a lot about the health of the job market. A strong job market with low unemployment and rising wages is great for savers. A weak job market can mean job insecurity and stagnant income, making saving much more challenging. Understanding these basic concepts is the first step to understanding how the broader economic environment can directly influence your personal financial situation. It's like knowing the basic rules of a game before you can develop a winning strategy. So, we've got the basics down. Now let's connect the dots. How do these big-picture economic forces, inflation, interest rates, GDP, and the job market actually impact your savings? 1. The inflation erosion. As we discussed, inflation is like a silent thief for your savings. If your savings account is earning you 1% interest, but inflation is running at 3%, the real value of your savings is actually decreasing by 2% each year. That $1,000 you diligently saved is, in terms of what it can buy, shrinking. This is particularly impactful for cash held in low-interest accounts. It highlights the importance of not just saving, but saving smartly. We'll get to strategies later, but for now, understand that high inflation is a direct threat to the purchasing power of your accumulated wealth. Imagine you're saving for a down payment on a house. If house prices are rising rapidly due to inflation and economic demand, and your savings aren't keeping pace, that goalpost keeps moving further away. 2. The interest rate. Seesaw interest rates are a double-edged sword. When central banks raise interest rates to combat inflation, it can be good news for savers with money in high-yield savings accounts, GICs or term deposits. Suddenly, your cash is working a bit harder for you, earning more interest. However, if you have variable rate debt, like some mortgages or lines of credit, your repayment costs will go up, potentially reducing the amount you can save. Conversely, when interest rates are very low, as they have been for extended periods in the past, your savings in traditional accounts earn very little. This can be frustrating and might push you to consider other options for your money, which come with their own set of risks and rewards. It's a constant balancing act. For instance, a young professional diligently putting aside $500 a month might see a noticeable difference in their annual earnings from interest when rates go from 0.5% to 4.5%. 3. The job market and income stability. This one is perhaps the most direct. The health of the job market is fundamental to your ability to save. If the economy is booming, strong GDP growth, and companies are hiring, you're more likely to have a stable job, potentially see wage increases, and feel confident enough to set aside a portion of your income. You might even get a promotion or a better-paying job, significantly boosting your savings capacity. However, during an economic downturn or recession, businesses might lay off staff, freeze hiring, or reduce wages. Job insecurity makes it incredibly difficult to save. Your priority shifts from wealth accumulation to simply covering essential expenses. If you or your partner loses a job, savings can be quickly depleted just to stay afloat. This underscores the critical importance of an emergency fund, something we'll definitely talk about. Think about someone working in hospitality during the early days of the pandemic. Their ability to save vanished overnight due to widespread shutdowns. 4. Market volatility and investments. For those who have started to dip their toes into investing, perhaps through a retirement savings plan or a brokerage account, economic conditions heavily influence market performance. Economic uncertainty, geopolitical events, or shifts in investor sentiment can lead to stock market volatility. This means prices can go up and down sharply. If you're saving for a long-term goal, like retirement in 20-30 years, short-term volatility might be less of a concern, and downturns can even be buying opportunities. But if you're saving for a short-term goal and have money invested that you'll need soon, a market dip linked to economic news can be stressful and potentially impact your plans. For example, someone saving for a house deposit in an investment account might see the value of their savings drop if the market reacts negatively to an unexpected GDP report. It's clear that these economic factors don't operate in a vacuum. They are interconnected and can create a complex environment for savers. You might feel a bit overwhelmed, but the key takeaway here is awareness. Understanding these impacts is the first step towards taking control. Okay, we've painted the picture of how the economy can throw curveballs at your savings. Now for the most important part, what can you do about it? The good news is, quite a lot. Here are practical strategies to help you navigate economic uncertainties and keep your savings goals on track. 1. The Bedrock, your emergency fund. I cannot stress this enough. An emergency fund is your first line of defense against economic shocks, especially job loss or unexpected expenses. Aim to save 3 to 6 months' worth of essential living expenses in an easily accessible, high-yield savings account. Actionable tip: calculate your essential monthly expenses: rent, mortgage, utilities, food, transportation, insurance. Multiply that by 3 to 6. Start building this fund before focusing heavily on other investments. Even small, consistent contributions add up. Automate a transfer to this account every payday. Think of it as your financial safety net. It's what allows you to weather a storm without derailing your long-term plans or going into debt. 2. Budget like a boss, especially when times are tight. A budget isn't about restriction, it's about control and clarity. Knowing where your money is going is crucial in any economic climate, but especially when inflation is high or income is uncertain. Actionable tip: use a budgeting app, a spreadsheet, or even a notebook. Track your income and expenses for a month to see your patterns. Then create a plan. The 50-30-20 rule is a great starting point. 50% of your income for needs, housing, food, 30% for wants, entertainment, hobbies, and 20% for savings and debt repayment. Adjust these percentages based on your situation and the economic climate. If inflation is squeezing you, you might need to temporarily reduce the wants category to maintain your savings rate. 3. Make inflation work for you, or at least less against you. When inflation is high, letting cash sit in a low-interest account is a losing game. You need to explore options that can outpace or at least keep up with inflation. Actionable tip for beginners: high-yield savings accounts. YSAs. Online banks often offer much better interest rates than traditional brick-and-mortar banks. Shop around. Even an extra 1-2% can make a difference over time, especially as central banks raise rates. Guaranteed investment certificates, GICs, or certificates of deposit, CDs. These offer a fixed interest rate for a set term, 1 year, 5 years. They are very low risk. In a rising interest rate environment, you might consider shorter terms so you can reinvest at potentially higher rates later. Consider I-bonds in the US or real return bonds in Canada. These are government bonds specifically designed to protect against inflation. Their returns are linked to inflation rates. Actionable tip for the investment: curious, investing in the stock market long term. Historically, investing in a diversified portfolio of stocks has provided returns that outpace inflation over the long term. If you're young and saving for retirement, this is a key strategy. Consider low-cost index funds or ETFs that track broad market indexes like the S&P 500 or TSX Composite. Remember, investing comes with risk, and it's about time in the market, not timing the market. Real estate, if appropriate for your goals. Real estate can sometimes act as an inflation hedge, as property values and rental income may rise with inflation. However, it's a significant investment with its own complexities and is not a liquid asset. 4. Stay informed but don't panic. React. Keep an eye on economic news and understand how it might affect you. However, avoid making knee-jerk reactions based on daily headlines. Financial planning is a marathon, not a sprint. Actionable tip: choose a few reliable sources for financial news. Dedicate a specific, limited time to consume it, e.g., 30 minutes a week. If you have investments, review your portfolio periodically, e.g., quarterly or semi-annually, and rebalance if necessary, but don't obsess over daily fluctuations. Panicking during a market downturn and selling low is often the biggest mistake investors make. 5. Continuously upskill and diversify your income, if possible. In a dynamic job market, being adaptable is key. Enhancing your skills can provide job security or opportunities for higher income. Exploring side hustles or freelance work can also create additional income streams to bolster your savings. Actionable tip: identify skills that are in demand in your industry or a field you're interested in. Look for online courses, certifications, or workshops. Even an extra few $100s a month from a side gig can significantly accelerate your savings or cushion you against economic headwinds. 6. Review your debts. High-interest debt can be a major drain on your ability to save, especially when interest rates are rising. Actionable tip: list all your debts, noting the interest rates. Prioritize paying down high-interest debt, like credit cards, as aggressively as possible. Consider balance transfer offers, watch for fees, or debt consolidation loans to get a lower interest rate, which can free up more cash for savings. These strategies aren't about becoming a financial wizard overnight. They are about taking consistent, informed actions. Start with one or two that resonate most with your current situation and build from there. The power lies in consistent effort and a proactive mindset. We've covered a lot of ground today, from understanding how inflation and interest rates work to seeing their tangible effects on your savings, and most importantly, outlining actionable strategies to navigate these economic waters. The economy will always have its ups and downs. There will be periods of growth and periods of contraction. There will be times when inflation is a headline concern and times when job security is top of mind. You can't control these macroeconomic forces, but what you can control is your response to them. You can control your planning, your habits, and your mindset. Remember, building a secure financial future isn't about reacting to fear. It's about acting with knowledge. It's about understanding that small, consistent steps, like setting up that emergency fund, creating a budget that works for you, or making informed choices about where to keep your savings, can make a monumental difference over time. The key takeaways from today's episode are: be aware, understand the basic economic factors at play and how they can influence your savings. Knowledge is power. Prioritize your emergency fund. This is your non-negotiable financial cushion. Make your savings. Work smarter. Don't let inflation silently eat away at your hard work. Explore options that offer better returns, aligned with your risk tolerance and time horizon. Stay disciplined, not panicked. Stick to your long-term financial plan, even when the markets or headlines are turbulent. The journey to financial well-being is personal, and it evolves as your life and the economy change. The most important thing is to stay engaged and to keep learning. You don't need to be an expert, but you do need to be proactive about your own money mindset. Thank you for joining me on Money Mindset Hub. I hope you found today's discussion insightful and empowering. Your financial future is being built with every conscious decision you make today. What are your biggest concerns about the current economy and your savings? What strategies are you using? Share your thoughts in the comments below. I'd love to hear from you. If you found this episode helpful, please like this video, subscribe to Money Mindset Hub for more content designed to empower your financial journey, and hit that notification bell so you never miss an update. Until next time, keep building that money mindset and take charge of your financial future.